Okay, all right. Before we start, allow me to read out the disclaimer for today's session. Okay. Um, Today's market webinar is intended for educational and informational purposes only, and participants shall not take it as financial or investment advice nor a trading signal. The accuracy and reliability of the information provided cannot be guaranteed. Pew Prime and I hosting the session are not liable for any losses or damages resulting from the use of the information presented today. Participants are responsible for independently verifying information and considering their own financial goal and risk tolerance. Okay, this is the disclaimer. All right, as you guys can see from the slides here, so today we mainly will discuss on the technical analysis, and I already hope that it might help you in any aspect in your futures trading. So yep, this is what basically we're going to cover today. Okay, briefly discuss what is technical analysis, and before we use any the technical analysis, what we should take note. And today mainly we'll discuss on candlestick pattern, and also after that we'll just briefly discuss some of the common price pattern at the end. Okay, so yep, let's dive in. So what is technical analysis? So we briefly know there's like a big two big difference of analysis available in the markets, right? Another one would be the fundamental analysis, and the other one is the technical analysis, which we are going to discuss today. So for fundamental analysis is you require you a lot of time, a lot of hard work, right? You need to dig deep into everything that you trade or invest. So it is more applicable if you are trading on stock markets, right? You need to know the background of the stock, right? You need to know the company, you need to know the country, you need to know the industry and things like that. But for forex trading, in general speaking, of course we sometimes do need to updates ourselves on any markets updates, like for example, later we have the FOMC meetings minutes, which is very crucial if you are trading with anything related to the USD. It will definitely have a great impact on the USD, on the strength of the USD later. Okay, so some time to time you also need to keep yourself updated to the markets, which is a little bit like a fundamental analysis. But regardless you are a scalping trader or a swing trader or day trader, I think it is very applicable for every one of us here to use this technical analysis. So what does it involve? So it just involves two very important components, which is the historical price and also the trading volume. Just these two things. But you know, as time goes by and now when people improve, with just these two components, it derives a lot of tools. You maybe you can name it. We have like RSI, we have MACD, we have moving averages, ATR, and a lot of things that I even never heard of, and which is also available in the market. But I think I don't dare to say 100%, but maybe 99% of the thing or the information will just come from these two components, which is the historical price and also the trading volume. So the philosophy behind a technical analysis is that we hope that by analyzing the historical price and also the trading volume, we really hope that the movement, the trend will repeat itself, and if we look at the past market information and use that to predict the future price movement, this is like what we want. So this is the ultimate goal from what the behavior that we see, and then maybe it can resemble some of the things that happens before in the past, and then we predict that, we hope that it will repeat itself, and then we open our position, we trade, and hopefully the trend, the price movement will go in favor in our way. Okay, this is I think the basic or the ultimate goal that we want to achieve by applying the technical analysis. Okay, so before we use this technical analysis, some of the keynotes that I can come up with. I wish you guys can know before you guys use this technical analysis. So technical analysis is very, very simple. So by analyzing all this price action, the trend, so you just want to get your best entry point, your exit point, and also do your risk management. Risk management meaning to say set your stop loss and set your TP, so you know where to take your profits, where maybe the price will just go weaker and weaker after it hits certain level, or you need to set a stop loss level, which is means that you have to have a place that you think that, oh, this is the extreme level that I can bear with the losses. I don't want to lose any further than this level, and I think if it's go beyond this level, it means that I'm wrong, and there's like no chance for the trend to turn around. Okay, so I think this is extremely important, regardless you using a fundamental analysis or technical analysis. You definitely have to do your risk management well. So meaning to say, set your TP and set a stop loss. And second point is everyone interpreting the chart pattern differently. We can look at the same thing, like everyone look at the gold prices chart. Everyone look at the same thing, but you and your friend might have a different opinion. You might think that, oh, after this candlestick, sure will have a rebound. You can open a long position, buy. But your friend might think, hey, no, I think it is a downtrend, or maybe it will have a technical retracement. I suppose we can open a short position here. So yeah, everyone look at the same price charts, everyone look at the same thing, candlestick, but we can interpret the chart differently. So yeah, so this is very subjective. So what we can do is we need to gain experience. When we trade more, and then we learn from it. Of course, when we do mistake, when we make losses, we take note, we take it down, and then we view it back. Why last time when I opened this position, when this thing happened, what actually fools me? Why I making this kind of mistake? And of course, we hope that in the future we don't want to repeat our mistake again. Okay. So yep, this is thing, and the very, very key thing is discipline. Discipline is the key in implementing technical analysis, because you have no argument. For example, if you're using this fundamental analysis and then you analyzing this stock, for example, you think that the business is good, but just that maybe yeah, COVID hit, the business like suddenly stopped, everything stopped, the whole world stopped. But you think the management is good, the company is the future of the world, right? It definitely will do a very good business, earn a very good profit after the pandemic is over. Then despite, regardless of what price it is, no matter how low it is, you might think that yes, on one day it will turn around and make you good profit, make you good return. This is fundamental analysis. But for technical analysis, this is not, I cannot say 100% not correct, but this is depend on you, like what philosophy, what method that you want to apply in your technical analysis. But of course, you have to have your norms, you have to have your rules, right? You build your own principle before you apply all these technical analysis. But the key is definitely is the discipline. So I come across, I have a lot of friends, and me myself in the past, I experienced to do this thing. I have a TP, I have a take profit level, I have a stop loss level. But what we do is sometimes when when we are greedy, we tend to tune the TP higher, because we think that the trend is in a correct way, and then we wish to make more profit, so we tune the TP higher. And then yeah, sometimes of course if we are lucky, then yeah, we can capture a better profit. But sometimes we just lose everything by being not disciplined. It's the same for a stop loss. Maybe I just want to lose like for example $50 with this trade, and then I set my stop loss level here, and I think if it hit here or go beyond this level, I have to admit that I'm wrong. But sometimes we just don't want to lose. We don't want to admit ourselves. We see things incorrectly, and then we just tune the stop loss level lower and lower, hope that one day it will turn around and it will turn to the way that is like favoring us. Then yep, we might just lose more and more because we keep lowering down our stop loss level. So please do not do this. You might be lucky one time or twice, but in the longer run, 5 years, 10 years down the road, if you keep a record, you will know this is not a good practice. It often incurred more or greater losses in our trading. Okay. And the fourth one, and I want to make you guys aware, is the market volatility. So when we have our technical analysis, where we are sometimes experienced and we know what to do and what we don't do, but sometimes the when the market volatility is high, as for example, when there's like a news or when there's an event happen in the market, it just happened right away. There's like a extra force, like external force, that will have a great impact on the markets that it is not applicable for the technical analysis sometimes. For example, later when maybe we look at the dollar, we think, hey, maybe the dollar might have a rebound at 104. Okay, the DXY index now maybe I think it's hovering at 104. So maybe we think that, oh, maybe later on when the FOMC, before the FOMC minutes come out or release, definitely after the US the US market open, maybe we'll have a technical rebound from there and potentially hit over 104.5. But what if the FOMC minutes come very, very dovish? Everyone, all the board member in a meeting suggest a rate cut, and I want to have like a 50 basis point rate cut, and because they think that inflation is over, but they just want to avoid a recession, what do you think will happen? Definitely the dollar will plunge and the rest of the pairing will just go up, it will shoot up. So we cannot fight with the external force, we cannot fight with the news and event. So make sure when you apply your technical analysis, you need to be aware whether or not the volatility in the market is high. Okay, and also I would say it is more efficient or more effective to apply it in a quiet market. So quiet market means like not at the opening markets, because we know, right, in the forex market, we know during Asia markets opening, during Euro market opening, during US market opening, it often have a very high market volatility in the first hour. But later of the day will be less volatile, will be more quiet. So during that period of time, when you apply it, then yeah, it will be better. And if you want to put it in a bigger or a longer time frame, let's say early of the year, like within like February, March, April, the market volatility tend to be quite high if you compare it to the festive season, like in November and December, because everyone just like started want to get into this festival mood, going abroad, going for vacation, and like less people are trading. So during that period of time, market volatility will tend to be lower. So in that period of time, when you apply a technical analysis, that will be more, the accuracy will be higher, I would say. Okay, so you need to be aware whether or not the market volatility is high. Okay, and lastly, market is always right. Do not argue with the market. You might be correct, like for some time you apply this norm, this, all the criteria met, but end up you still make losses. So, but yeah, market is always right. You don't argue, but you just keep going, and maybe just fine tune or correct your mistake and goes on. You cannot argue with it. You cannot take your money back. It is how it is. Okay. So these are the key notes that I can come up with. And also lastly, the star note is you have to know behind every prices and the trading volume is human. But it's not the asset itself. So what I want to try to say is all these things come from human. So if you look at the chart, you need to think away like this, like what is other people thinking? What is next? What is your friend thinking? What is the people from the other side of the world thinking? What is the market thinking? So this is the thing that you want to, consider.
because it is not the gold price have the movement itself. It is not the gold, not the oil, not the US dollar to have
A price movement itself. It's all manipulated or is controlled by billions of people in the world. Okay, so you have to think like this, and after that, the next candlestick or the next price movement, you will think what happened next, what other people's gonna think after this happened, after this candlestick is formed, after this event came out, after this economic data came out. What is next? What other people are gonna think or perceive of the result, right? So if you have this thinking, I think it will help a lot in your day-to-day trading. Okay. And yeah, moving on, like I say, today we will mainly discuss about candlestick. Of course, if you look at the chart itself, we have different way of interpreting the chart. We have a bar chart, we have line chart. Okay, of course, like for line chart is very hard to tell because it depict in a way is quite simple. And yeah, for me in general, I'm a big fan of candlestick because every single candlestick it tell me more thing if I just look at the line, if I just look at the bar. Okay, we have different way of interpret the price movement, but I'm a very big fan of a candlestick. So yeah, let's go through what is a candlestick. So for candlestick, right, if you look at a picture on the right hand side, every single candlestick tells you four things, which is the opening price, and also the closing price, and also the highest price at that particular time frame, or the lowest price at that particular time frame. So we have like 1 minute, we have 5 minutes, we have 30 minutes, we have 1 hour, we have 4 hours. So if you choose, for example, a 4 hours candlestick, so this is the price within that 4 hours. Okay, within that 4 hours, when it opens, it open at like the first minute, and it close at the last minute at the end of like the 4 hours. And this is the higher price within that 4 hours, and this is the lowest price within that 4 hours. So this is what we can see from every single candlestick. So when the closing price is higher than the opening price, it is a bullish candlestick. So normally we'll put it in a green color. So conversely, if the closing price is lower than the opening price, then we have a bearish candlestick. It means the price go lower. So yeah, this is how it is. This is how we look at the candlestick from every single candlestick. It tells us four things. If you compare to other way of depicting the chart, I would say candlestick it tells us more information. Okay, moving on, let's discuss some of the candlestick pattern. So this is like we just look at one single candlestick. Okay, so we have two different things. I mean the shape of the candlestick is the same, but we just happen at a different place of the chart. Then we have a different meaning of it. So we call it hammer or hangman. So a hammer is it appear at the end of the downtrend. So when it happened, then this is a signal to tell us maybe there's a high chance for a trend reversal. Maybe from here is mean that maybe we will have a technical rebound if we see a hammer. So how is a hammer look like? Is the name tell itself. So it just look like a hammer, where the logic behind it is the price go very low, but there is a buying power come and push the price higher, and close higher. So it means the strong bearish trend, the momentum is easing or soften or vanish, and here come a strong buying power that push the candlestick all the way up, and we've left with a very long tail, or we call it wick, right? And we think that here is the change of the momentum. So then we hope that the next one will have come with another bullish candlestick, and then it's quite confirmed to tell this is a trend reversal signal. It is a hammer. We can open a long position here. So likewise, the same thing. After a long uptrend, here come a hanging man. When the price just try to push, but close back low, and then we think that this the trend is not sustainable. The selling power is coming back, and then will push down. So here is like a trend reversal for a bullish trend. So from here, then we can think, oh, maybe we want to have a short position from here. Okay, so these are the different. It's the same shape, it's the same candlestick, but it just happened to be at a different place of the bar chart, price chart. Then it tells us different meaning, but it's the same. It just gives us a signal of a trend reversal. Okay, so this is a single candlestick, right? So this is the example. Okay, if you see after a long bearish trend, but this particular candlestick is still not a hammer, so we cannot take this into account. But here come a hammer, then we think we can catch a short-term a rebound from here. And then after that, the trend continue. But here come again a hammer, then maybe we can try again a rebound from here. Then we can open a long position here, and then the rebound is ready come. So we can see here we have a two hammer candlestick happen here. Okay, so these two just give us the example. The second one is engulfing. So engulfing needed two candlesticks to come together to tell us whether or not we have a trend reversal. So the logic behind it is also very simple, which means that we have a very solid candlestick come after a different candlestick. So for this example here, if we have a downtrend, we have a bearish trend, and then we have a short bearish candlestick followed by a big solid bullish candlestick. This means that this bullish candlestick engulf the bearish candlestick. It means that this is a bullish engulfing. So after we notice this happen, then you have to have like this ding dong of an alert. Then maybe think that, oh, maybe there's a trend reversal for this trend. We can consider to enter the trade, and we can open a long position. Likewise, the same, if we have a uptrend, bullish trend, and after a shorter bullish trend, bullish candlestick followed by a huge solid bearish candlestick, this bearish candlestick engulf the bullish candlestick. It means we have a bearish engulfing. So again, an alert for you guys to know, hey, maybe we have a trend reversal. Maybe we can consider a short position here. Okay, so this is the logic behind this engulfing. Okay, this is the example. We have a very short bearish candlestick, and then we have a very solid bullish candlestick, and this is a bullish engulfing has formed and rebound started. And this example is very sharp. It's very strong, this rebound. And it's the same thing. This is a very short, tiny bullish candlestick followed by a very huge, solid bearish candlestick. And then, yeah, a reversal for this trend. So these are like we needed two candlesticks to know this price pattern. To know this signal, to know this trend reversal signal. Okay, the third one that we're going to move to is we needed three candlesticks. So we need three candlesticks to confirm that this price pattern has formed, this candlestick patterns has formed. Okay, so what is it? Is the morning star and an evening star. Why we call it a morning star? It means, we are in the dark time. The trends go down. This is the bearish trend. Go down, it's like a dark time. And then this dodgy candlestick appear. And dodgy candlestick after this appeared with a bullish candlestick. So we have a solid bearish candlestick, a dodgy candlestick, and a solid bullish candlestick. So these three together, if these three come together, it means that we have a morning star. A morning star is like the light at the end of the tunnel lah. So the sunrise, right? So it means that we might have a rebound. We might have a trend reversal after a bearish trend. This is the morning star. And the same thing, this is called evening star. Means the sun is going down. The dark night is coming. So this is mean after a long bullish trend, after a solid bullish candlestick, come a dodgy candlestick, and followed by a solid bearish candlestick. After these three come all together, it means that this evening star candlestick pattern is formed. So when we notice this, it just tells us we have a trend reversal. We can consider to TP, or we can consider a short position. Okay. So this is the example of Morningstar. This is the trend, and then we have a doji, but this week is kind of long. Okay, and then we have a rebound. Okay, this is another example. This is the we have a very big, huge, solid bullish candlestick, and then with a doji candlestick, and then big, solid bearish candlestick. This is more obvious. Okay, this price pattern is more obvious. You can have a look, and then just go through all the chart, and then if you notice this, then you know what to do next, right? Okay. And after this webinar, you can go through one by one by all this all the chart that you have. But bear in mind, we have a FOMC meetings minutes to come in the way, so please apply it after this huge news. Okay. And moving on is the entire trend. This is not one candlestick. This is not two candlestick. This is not three candlestick. It's the entire trend. So the common price pattern, the first one will be the head and shoulder. Very obvious, we have a left shoulder is formed, and then come with a head and come with a right shoulder. And most importantly, we have to get the neckline. The neckline is like this, but it's not often horizontal. Sometimes it will have what we call have an angle. It is not like 100%, it's like 180 degree. Sometimes it tilted a little bit. Okay, so this is have to bear in mind, because in the real life markets, everything just will not come like a textbook, right? For this is just for you guys to have a better understanding, to understand it better why we call it head and shoulder. So when we react, when it's like after we notice this already, oh sorry. After this has formed a left shoulder, a head, and right shoulder, then this tells us, hey, the bullish trend has ended. The logic behind this is mean that the bullish trend is already softening, is easing, this lack of momentum anymore, because it doesn't rebound higher, because the third shoulder or the third peak is lower than the previous peak. It means that the momentum is gone, is diminishing. So we can react at the neckline, and then we can open a short position here. So this is where we react after we observe this kind of price pattern, this kind of candlestick price pattern. But this is not just applied for candlestick, I would say this is applied to all kind of tools that you want to use it, or whether or not it's a line or it's a bar. And whether on so the same logic apply to an inverse head and shoulder. So but just that the meaning is different. We have a you can imagine we have a very long bearish trend, downtrend, and it go lower and lower. This is like a lower low, but after that it rebound, and then we found this neckline, and after that it still continue to go, but it didn't form another low. It have a higher low. This means that have a chance for a trend reversal. So where we can react at the neckline that we can find. After that, we can open a long position here. We buy or open a position here. Then we hope that this trend will continue, goes up. Okay, then the bullish trend come. So this is the logic behind the head and shoulder price pattern. Okay. And moving on is the triple or double top or bottom. So the logic behind this is also very similar to the head and shoulder, and it's often we can find it also in the markets, right? So we go with the double bottom first. The double bottom means that when we have a bearish trend, but it rebounded at a certain level, rebound and go lower, but it rebounded at the same or a very near range of the level, goes up because it didn't form a lower low. It just happened rebounded at the same level. Okay, and then this means that maybe we will have a trend reversal. Then maybe we can react at the peak that it previously formed. We can open a position here. But you can see what is triple top. Sometimes maybe we can lose, right? If we open a position here, we hope that the trend will continue. We're bullish. We'll have a trend reversal. Then we can make profit from this bullish run. But sometimes we just fail, come down again. So it is very wise to use to have a stop loss level. But of course here, right, because we expect the trend to maybe have a chance to go back to this level. So maybe we can set our stop loss level slightly lower than this level, slightly lower. And then, but of course, remember to set a stop loss level. And if really when the trend rebound at this previous low level, then we are still making profit. We go back to this level and go beyond, then we're making profit. So yeah, stop loss level is very, very important. But because just sometimes the market just doesn't go with the way that we think, we hope it goes. Okay, the same thing go to a double top. The meaning to say the bullish trend is the bullish momentum has already eased. The momentum is getting weaker and weaker. It cannot form another high. Okay, just go back to the same level. Then again, we can open a short position at the previous low and hope that it will form a lower low. Okay, and then we can make a profit from there. We can make a profit from a short position. Okay, but again, if this didn't happen, it want to form a triple top, then it's still okay because if we have a stop loss level higher than this level, slightly higher, okay, and then we're still making a profit after all. If no matter it is a double top or a triple top, we still can make a profit if this happen. If we can capture these price patterns wisely, okay. So yeah, this is the double, triple tops and bottoms. Then it's quite often that we can get these kinds of price pattern in the markets lah. So yeah, you can go back and look back to the older chart, and then you can find it and then you apply it. You can actually back test it. Use a demo account. You can back test all your strategy of your method to see whether or not it is work. Okay. Lastly, the price pattern will be the triangle price pattern. This is kind of hard because we cannot get like 100% the triangle, the shape correctly or the shape nicely. But just sometimes it just resemble this a shape. So here we have three triangle pattern. We have the symmetrical triangle pattern. We have ascending triangle and descending triangle. But I want to tell you guys, I want to warn you guys is it doesn't always come how would I put it? Okay, for example, this symmetrical triangle patterns, right? Sometimes it will also go a different way. Okay, it can go this way as well. It could happen. Okay, it don't necessarily always go up after it break or after it break the symmetrical triangle pattern. It can become this. Here is the same. Maybe we have a same line. Okay, like cannot form a higher high, and then cannot form a higher high, but we can form a higher low, higher low, higher low, higher low. But sometimes the market can go this way. But just like most of the time, it break above, which means this trend will be very, very solid. It will be very, very strong. Okay, it is the same logic to go with this descending triangle pattern. We have a lower high, lower high, lower high, lower high, but sometimes can go this way. Okay, but if just go in line with our expectation, break below this very long support level, go lower, it means that this bearish trend will be quite strong if this happen. So this is a bit more tricky. Okay, and first thing is not always come with an exact nice triangle shape. You have to have some imagination yourself. But yeah, you just need to follow the higher high, higher low, the lower level, higher level of the price pattern, then you can draw a line. But I want to warn you guys is this could happen, but just that these chances will be higher. Okay, this means that when this we have this means that when we have a very strong resistance level, and once it's break above, the chances will be higher. The same goes to this one. We have a strong support level. Once it's break below, the bearish trend will be very solid, and this tend to be the possibility will be higher. Okay, this is the triangle price pattern. Okay. Okay. So here is already the end of our session. But before that, I want to add to you guys is no matter what time frame you want to apply, whether or not you are a scalper, whether you're a swing trader or day trader, it is wise for you guys to always go with a bigger time frame. So after you have a bigger time frame, what you do is you need to observe whether or not you have a higher high or you have a lower high. So from there, you can know whether or not this is a downtrend or this is an uptrend. So after that, when you go to a smaller time frame, you go to H1, then you can know, oh, now we are in an uptrend. So maybe it is more wise for us to trade with a long position rather than a short position. Okay, this is what I always practice. I always go for a bigger time frame, and I want to see it in a bigger picture, whether or not the current trend is in a bullish run or a bearish run. After that, when I go to a smaller time frame, then I will go and look around whether or not we can get a triangle pattern, whether or not there's a head and shoulder pattern, or whether or not we will have a dodgy candlestick that signal us for trend reversal, things like that. When it's in line with the bigger time frame, then I will go and try. When I try, I will set a TP level, I will set a stop loss level. Depends on my risk appetite. So again, I advise you guys to do the same thing, practice the same thing. It is very, very important. It required a lot of high discipline, behavior for you to become a good trader. Yep. So here come to the end of the session. Okay, and also